Welcome to Informed Investor. Vodafone Idea Limited, India's third largest telecom operator, is making noise signing some massive contracts. In fact, Vodafone has signed a massive 30,000 crore deal, approximately $3.6 billion deal with Nokia, Ericsson and Samsung to upgrade its existing 4G and 5G network equipment across the country over the next 3 years. This move is part of the company's announced 3-year capital expenditure plan of around 55,000 crore rupees. This new contract is a significant investment for Vodafone, which has been struggling financially in recent years. It is expected to help Vodafone to improve its network quality and coverage and compete more effectively with its rivals Reliance Jio and Bharti Airtel. A point to highlight is that Vodafone still offers only 4G to its users. This deal will help Vodafone generate new revenue streams by offering new 5G based services to its customers. This positive news created a perfect storm for Vodafone shares, which rose to about 12% as soon as the markets opened today. Now, since we're talking about Vodafone, let's deep down and understand Vodafone's journey and how it stuck with this massive amount of outstanding dues. Back in 2007, Vodafone India made a significant entry into the rapidly growing Indian mobile phone industry. At that time, Hutchison SR, also known as Hutch, with its famous advertisements featuring the pug breed, was thriving in the Indian telecom sector, while Vodafone held a prominent position as the largest telecom company in the UK. Vodafone decided to expand its operations into the Indian telecom market, recognizing the immense potential and growth opportunities it offered, and bought over Hutch SR for $10.9 billion, approximately 46,870 crores. Vodafone India then made several improvements. They invested more money to enhance the network, which led to smoother internet connectivity, quicker messages delivery, and clearer calls. Customers were delighted because they were experiencing better services than ever before. Despite facing fierce competition from well-known companies with the likes of Reliance Communications, BSNL and Airtel at that time, they quickly grew their customer base to 100 million users by 2010, which was a proof of its successful strategy and great execution. Then Vodafone made larger network upgrades in order to provide high-speed data services. This was a timely move because data consumption increased at that same time as smartphones became more popular. They even did aggressive marketing campaigns like the ones we remember of Zuzu's. Vodafone then took it a notch higher, announcing its merger with another emerging player, Idea Cellular. The merger, valued at around $23 billion, aimed to create India's largest telecom operator at that time, surpassing Airtel in terms of subscribers. The primary motivation behind the merger was to build a stronger company capable of more effectively competing with rivals like Reliance Jio and Bharti Airtel, particularly after the disruptive entry of Reliance Jio with its aggressive pricing and innovative offerings. Though the merger initially was a game changer, making it the lead player in the telecom sector, boasting a market share of 36.5%, it soon had troubles one after the other. As you can see in the chart, in October 2018, Vodafone Idea was the leading player, but there was another mammoth of a player emerging, with Reliance Jio quickly rising to fame. As of 31st July 2024, Reliance now leads the pack with 40.6% market share, followed by Airtel closely behind at 33%, and then comes Vodafone Idea at around 18.4% market share. Interestingly, more than 92% of market share is held by private access service providers. The declining market share and losing subscribers is not the only problem. Vodafone Idea incurred significant problems, one of which was heavy borrowings or indebtedness along the way to keep up in the competitive landscape, amounting to 2 lakh crore. In fact, 97% of the total loans are owed to the Indian government in the form of AGR liabilities and deferred spectrum payment obligations. What's interesting to note is that on February 7, 2023, Vodafone Idea allotted 16.13 billion shares to the Government of India, converting the adjusted gross revenue or AGR dues until fiscal year 17 into equity shares. Following this allotment, the Government of India now holds about 23.1% share in Vodafone Idea Limited, making them the largest single shareholder in the company. To tackle the ongoing issues, Vodafone then issued a massive IPO of 18,000 crore rupees to pay the outstanding dues to the Department of Telecommunications and also expand capacity of existing sites and set up new 5G sites. In fact, the FPO subscribed more than 6 times. Now that we've completed the entire journey and the timeline, let's look at the financials. The sales have shown an overall upward trend, growing from 19,489 crores in fiscal year 12 to rupees 42,652 crores in fiscal year 24. Expenses have also generally increased over the years, rising from 14,440 crores in 2012 to 25,580 crores in fiscal year 24. While sales have increased, the corresponding rise in expenses has impacted profitability. What's impressive is that the company exhibits strong operating profit margins, translating to almost 40%, showing good operational efficiency. But now when we looked at the bottom line, the losses widened to rupees 31,238 crores for fiscal year 24 on the back of super high interest costs amounting to 25,766 crores for the same period. In fact, the net profit has been consistently negative from 2018 onwards, with the largest loss of 73,878 crores in 2020. EPS has also followed a similar pattern to net profit, turning negative from 2018. The most severe decline was in 2020, with a negative earning per share of 25.71 rupees. Now, if looked at the key metrics, ARPU, which is the average revenue per user, it has seen a consistent rise to 146 rupees in Q4 and the first quarter of fiscal year 25, adding to the top line growth. However, the company has seen a decline as subscribers as well as competitive rates and services offered by the competitors. Furthermore, the borrowings and outstanding dues have been significantly adding to the woes. Now to conclude, despite the massive FPO of Vodafone followed by a deal of 30,000 crore with Nokia, Ericsson and Samsung, it's not all rain and sunshine. While it will help Vodafone to improve its network quality and coverage, Vodafone faces intense competition in the Indian telecommunication industry, primarily from companies like Airtel and Jio. Additionally, the financial woes in the form of debt payments, the ongoing legal proceedings, could potentially divert its resources and have a negative impact on its reputation and financial health if outcomes turn out to be unfavorable. Now, only time will tell if Vodafone's bet pays off, allowing it to compete in the highly competitive Indian telecom sector. With that, this is me, Ralston, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.